Welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
We're both property people running our own businesses. This podcast is just us talking, as we often do, about anything and everything property. Well, hello again, Simon.
And hello, Stuart.
Today, we thought we'd have a chat about terms. I guess in our minds we were thinking it would be good just to lay down a bit of a glossary for the stuff we talk about. And I'm sure a lot of people know the terms, but for those that didn't, we thought it would be good just to get into some of those acronyms that we might just throw out there.
Yeah, indeed. And in brainstorming for this, we've already come up with enough acronyms, we think, for 3 or 4 episodes. So so this is just going to be a starter starter episode on the glossary terms.
Yeah. And I think the first one we all talk about, because this is the one that we measure a property's feasibility or viability, is yield. We talk about gross and net.
Yeah, lots of people do use that to measure a property's viability, but I'm not so convinced that they should. And I think you mentioned similar thoughts as well.
Well, I just think it's a strange thing to do, is to base your, interest in a property based on your purchase price and rents. That
we should probably define yield, shouldn't we?
Yeah, well, that's what we said we were going to do.
Sorry, I interrupted you.
No, it's fine. So yield simply is taking your gross rent, that is the total amount of money that you're going to rent a property for. So if that's £500 a month, your gross annual rent would be £6,000, divided by your property purchase price. Let's just say, for the sake of this conversation in my brain, £100,000. So we divide 6,000 by 100,000 and times that by 100 to give us a percentage, which I hope would be 6%.
I'm going to take your word for it. As we've discussed on previous episodes, my mental arithmetic is not up to anything.
So that's what I do. So when I look at properties, actually I still do it, but I don't gauge a property on it. It just seems a strange one to me, because a purchase price isn't necessarily, if I'm honest, I don't see how that reflects on property suitability. For me, it's more around actual cash flow, another term.
Yep.
But anyway, so we better finish off that explanation. Would you like to do net yield?
Why would we consistently finish anything off? We don't normally. Yes, okay. So the yield you just described is sometimes described further as gross yield. And there's another term, net yield, which is where, rather than taking the total rent you receive, you take the total rent you receive, subtract off expenses, and then use that number and divide it by the purchase price.
Yeah.
So this is getting a little bit more realistic, I think, because you're looking at expenses, and expenses typically in property investment are quite big.
Yeah.
But you're still only looking at the purchase price on the other side of that.
Yeah, and I suppose why you do that, because that's okay. This is just me thinking aloud on the podcast, but that's so. If we're talking about investment, just underscoring that word, we're talking about investment. So if we've got an investment and you've purchased the property for £100,000, now the second part is obviously you're not investing it. You're not necessarily outlaying £100,000. However, the asset value we are saying is £100,000. It's giving you £6,000. Just going to continue my original example.
Yep.
And let's just say that figure's net based on your guidance you just gave there. Now we're talking about some real terms. We're saying, okay, I've got an asset which is worth £100,000, which is now giving me a 6% annual return. So there, as you said, I think it's making a little bit more sense.
Yep, it is. I agree. It's getting closer to reality, I think. But as you mentioned, most of the time, property investors don't put £100,000 of cash into buying a £100,000 property.
Nope.
Not least because when you buy a property, there are other expenses like stamp duty and legal fees and whatever else. But also, there's normally some kind of borrowing involved against that asset. So we can introduce another term, a mortgage. So this is just a loan secured against a property. But it's not always a mortgage. Sometimes if you're looking at other sort of purchase and refurb processes and things, there might be bridging loans. And sometimes there's also a mix of money coming in So there might be multiple investors involved putting money into a property as well. But anyway, so take a step back again. So we've got a £100,000 asset. This is where I'm going to make up complicated numbers, and you're going to hopefully do all the maths for me. But anyway, so we might have a 75% loan on that.
Yeah.
So another term, that's LTV, or loan to value. So 75% of the value of the asset is a loan. So we're only actually putting in £25,000 of cash, plus the stamp duty, plus expenses. And I think it makes, well, for me, I think it makes a lot of sense, or the most sense, when looking at returns in property, to look at that total amount of money that you put into a property against the net rent that you get back from it, or net income. So this is often summarised as a term called ROI, or return on investment. So investment is the cash you're putting into the purchase, and return is the profit you get back each year at the end of that. So if we put in 25,000, let's not worry about stamp duty for the time being, make that a bit easier. So we put in 25,000 and we've got £6,000 of net rent. We would then do 6,000 divided by 25,000 to give us our return on investment. Now, Stuart, can you do that mental arithmetic? I can't. Oh, a calculator comes out. That's the way to do it.
Well, my head's saying 40%. What do you say? If you're saying 6,000, 25,000, it's 24%.
So that investment looks pretty good now. Previously, we were looking at a 6% return based on net yield. But now, when we're looking at ROI, we're looking at, what did you say, 24%? Mm-hmm. That's pretty damn good.
Yeah, because if you think about it, 6,000 is a quarter of 25. So
I'm not going to follow the maths. Don't try and explain it. It's fine.
I'm enjoying this. I like seeing you squirm a little bit in your chair.
I'm great with a calculator or a spreadsheet. Mental arithmetic, I'm just not there, I'm afraid.
So I think the valuable point here is for me is you measure things how you want to measure. And what's great about property, and I guess why we're interested in property, is because, so for me, your return on investment is very similar to my return on capital employed. So ROCE, return on capital employed, is how much money am I putting in and I'm going to get back. The difference for me is return on capital employed is just that initial outlay, because you could argue then that, you know, your ongoing interest is not 24%. That's just year one.
Yeah. This is where it gets quite complicated.
It is.
Yeah. So let's take the scenario. You bought your property, you've got your initial outlay. As you say, that's your year one return. When you go into year two, what do you count as your investment now? Is it still just the money you put into it? Is it the value that is still in that asset? So perhaps you might still exclude the mortgage or the borrowing you've got against it, but your cash, your deposit that's in that, perhaps that's your ongoing investment. And then what happens 3 years, 5 years, whatever down the line, when you remortgage that property and you take a bit more cash out of it, what do you then use as your investment amount? It gets quite complicated, and there are lots of different terms around this, which I probably can't remember right now, to try and cover these different scenarios. But I don't think there's any one right answer, really.
Well, I think for me, as we're talking this through, I think that's where their net yield comes to the fore, because that's our consistent measure, isn't it?
Yep, exactly. That is the one value in yield measurements, is that it's consistent.
And will also track against current market values.
Yep, exactly. Yep.
Versus, so in my head, and why we all know and love property, is that based on your investment amount of 25,000, your rental, you know, should you have been lucky enough to purchase and invest for 25,000 and have a net rental income of 6,000, we know that in 4 years you are cost neutral. I know that's just a fancy way of saying you've got no money left in the property. All your money's come out. So actually, in real terms, your ROI is infinity,
Yeah.
because it's now you've got nothing and you've got £6,000 a year.
Yeah, exactly. And there are some property deals, I've never experienced one, but I believe they exist, where you can actually achieve that much earlier, where you can buy a property that's in need of some TLC. That's not a property term, that one. And then you do the refurb, add value to it, and perhaps you use bridging finance initially, and then you come off the bridging finance to a longer term mortgage. But at that point, you may already have no money, or at least a lot less money in terms of cash left in the property.
Also known as the holy grail of property development. And funny enough, I am working on one now which could... I've only been working in property 3 and a bit years. Well, I've been a landlord owner for 13 years now, worryingly. But in terms of working on some of these models, it's only been a handful of years. But my experience is that those things are possible. They're not as easy as some people might have you believe, but they are possible. But they take, like everything else, time and effort. I'm working on one right now, actually, which I don't want to be too explicit on the details, but we'll be purchasing it for about 115. If it goes the way I want it to go, we might spend 40k on it. So again, it doesn't include stamp duty, and I can't remember the numbers from the top of my head. But we're looking 155 plus the SDLT, stamp duty, land tax, as this is a glossary episode. But we should be getting that revalued at 200,000 if that goes well, and that's based on me getting the right tenant type in there and creating the right number of rooms. The reason I'm highlighting this is because what you said is absolutely true, that you could do this on your way into the purchase. However, I then would come back, unless you've got we've talked about mortgage bridging loans, unless you're investing with 100% cash, which a lot of us, not everyone, but a lot of us aren't endowed enough to be able to do that. If you can do it with cash, then great, but then you've still got some sort of cash on the table and you can mortgage out. But when you're getting a mortgage in, I still have to look at the loan to value against that revised value. I hope that makes sense. I'm just trying to clarify that what you're talking about can be done, but for me, there's always going to be a little bit of money left on the table because I haven't yet reached that point where...
Yeah. So, I mean, well, if we take that example, you put 155 in to buying the property and refurbing the property. If you then mortgage it at 75% loan to value, you're going to be looking at...
Well, that would be 150 on 75%, but I would look at 85% on this because it's a multi-let.
HMO, and you can get mortgages to go a little bit higher
different.
On that.
Mm. Yeah.
Okay, so I was going to say you just have £5,000 left in the property, plus your stamp duty. But yeah, if you're going up to 85%, I can't do that in my head anymore. So
well, my phone tells me it's 170,000. So then you're close. So you're all of your money was 155 plus your legals, couple of grand, SDLT. I can't do that in my head, but there's a big calculation that I've got in this spreadsheet. But actually, on 115, it's not a huge amount. 5. Yeah. So there we're up to 162-ish. And then miscellaneous. So so you're getting close.
Pretty close to getting all of the money back out again. Yeah. So you say very close to that holy grail.
Yeah, it's very close, but we've got experience, so we don't have to sit here and say, yeah, you're going to get all your money, and we're not trying to sell the next course to do that. So we can be quite honest about it. And my feeling on this is always that, guess what? Since 2008, since previous crashes, the banks will always limit. So even though they might offer an LTV of 85%, they might look at everything in its entirety and say, do you know what, we'll loan you up to 160 because they have grown as the market has. And my personal view, this is my opinion, which people can use or not, is that now banks have become attuned to that, and they want more people, whether you're buying as a limited company or not, but they want more people to have skin in the game.
Yeah. Completely agree.
Because once you've got skin in the game, like if you could just do this 10 a penny, if you could get those 105% mortgages, instant mortgages that used to exist, how much interest am I paying in that property? If all of my money's out and I'm done, actually I've got no skin in the game, what's the likelihood I could just not look at that property anymore, not give it any attention? because the bank's money is in that bricks and mortar. So for me, if I think it through, that's just where the common sense lies, isn't it? Their money's in that building, and if you don't give a monkeys about that property and it falls into disrepair, their money is worth less, isn't it?
Exactly. Yeah, they're the ones who are going to suffer rather than you. So hence they want to make sure that, as you say, you've got skin in the game, so you suffer with them.
Yeah.
No, I think no, that's not quite right, is it?
But yeah, in a
so
way it is.
You make sure neither of you suffer. That's the one.
That's the point. However, but the converse is true. There's that they want to know. Well, actually, if we go down, you're coming with us. That's that's the negative. But the positive is yes, we both want it. Because I actually had this experience on a property that I worked on a couple of years back, where it worked out really well. And sorry, I think we've digressed a little bit.
That's okay. We always do.
And I might have spoken about this previously, but I bought a property, and I've always caveated this by saying it's the only one this has ever happened on. Hasn't happened before or since. But I bought it for $540. I spent £12,000 on it, and the independent valuation, RICS valuation, RICS, Royal Institute Chartered Surveyors, came in and valued it at $735 bought it in November, and it got valued in January. So within 3 months, they'd upgraded the valuation by approximately 200,000.
That's good going. Very good going.
It's amazing, but I always say to people, that was brilliant, but it's very hard to achieve because, and I'm going to be completely honest, that happened by luck, not judgment. It wasn't by anything special I did. Obviously, I planned to get a really good valuation, and I put in a high valuation, but it's very rare. However, the point I want to make is that even though the bank previously, on the first purchase, when we went on a bridge, went in at a 75% LTV, the mortgage company was going to give a 75% loan to value. But just to highlight the point, they said, actually, we'll only loan up to 70%. Although our product is 75% LTV, we're only going to go at 70% because we don't want to take that risk.
Yeah, quite.
And that's why. So there are stoppers.
Yeah, I think there is a lot more individual consideration being given these days to mortgage applications. It's a lot less sort of automatic rubber stamping of them. Yeah. Yeah, you get more complicated situations.
And I think just on our point, so we're talking about yield, ROI, ROCE, cash flow. If you've got more than one property now, certainly.
Actually, we haven't talked very much about cash flow. We should go into that a bit more. Go on, Karen.
Well, do you want to talk about cash flow?
No, you finish your point.
So all I was going to say was actually, if you own more than one property now, the likelihood is the bank, whichever bank it is, most banks now are more likely, and certainly will if you're now buying a limited company, they will want a business plan. So you need to be clear on all of these things.
Yeah, there are various cut-off points, I think, aren't there? There's, is it 4 rental properties that they start asking for the business plans, I think?
It sounds, but I don't know.
Yeah, and I'm sure it varies by lender as well.
It will do.
And then I think there's another cut-off point that tends to be around 10 properties, where all the interest rates go up for starters. But I think also some lenders at that point add in extra checks and extra due diligence on their part. So yeah, there are various points where it does get harder, and certainly for the much larger landlords out there, the processes are.
Yeah. So that's why these terms are actually important. And from my side, we create a business plan anyway because I share it with investors, and it's very good. As soon as the bank says we want a business plan, even though you have to fill out their own blooming documentation, I usually just send out a little deck as a PDF so that they now understand that you are a professional business, not just a fly-by-night.
Yeah. Do you have you had much feedback on that? Or I suspect it just sort of disappears into the black hole of the lender, and you never hear another word.
Exactly.
Yes or no.
Yeah.
But
it's never hindered, and all of those mortgages I had, I think usually you'd hear back if it wasn't good enough.
Yeah.
So for me, no news is good news from a bank perspective.
Yeah, correct. So I thought perhaps we should mention a little bit more about cash flow. So this is how do you define cash flow? How do you want to have a go, Stuart?
Well, for me, cash flow is just what we work out as what we are receiving at the end of each month, or whichever sort of period we're looking at.
Yeah,
so,
I'd agree. Cash flow for me is much more a monthly thing than an annual thing.
Yeah. Even though cash flow from my student business it's tougher because in the student business we take revenue at the beginning of term time. So September, January, April, and then I think, that's about it. I think,
Yeah. Three times a year. Yeah.
Roughly that. So we have 3 big chunks, but obviously as a business, you've got costs coming out every month. Obviously, without going into it, utilities, the mortgage, etc., etc. So I then look at the cash flow, and I've actually got a cash flow document where we punch in all the figures, we punch in the rentals of each room, and we're looking at the ongoing cash flow. In fact, it's one of these things where people say to you, cash is king, your business will live or die by cash flow, and they're just words until you experience the challenge of running a property business that isn't generating enough cash to support. Then you realise just how true all of those words are.
Or even if it is generating enough cash to support it, but just not at the right times. So, as you say, if you've got lumpy income, it's sort of 3 times a year or whatever, but you've got regular expenses, you've got to make sure that you keep enough of that income on hand or available to cover all those following months.
Yeah.
And quite often we get unexpected expenses, sort of a leaky roof or a boiler gone bang or whatever. So there can be some unexpected and lumpy expenses as well, which can often be difficult.
And what you've just articulated there is my business, and it's really challenging, because to smooth out that revenue is really, really hard. And unfortunately, every month, we have had the roofs. I've got 2 roofs on different properties that they're going, and for my properties that are 3-4 stories, when you talk about scaffolding and stuff, you're talking about a couple of grand. We're not talking insignificant amount. Washing dryers, £330, that's come through yesterday. So all of that has a difference, and personally I have investors to pay back, so it all comes out of the cash flow. So when people say cash flow is the lifeblood of your business, it's the lifeblood of your business. Because if there's zero income, how do you pay the mortgage? How do you pay the utilities on that month? Well, unless you've got external resource, that's not going to happen.
Yeah, quite. And it's surprisingly easy for things to come crashing down quite quickly if you can't keep that cash flow flowing. It's I think it's why it's always good to have a little buffer in reserve for things like the unexpected boiler repair or what have you.
Yeah.
I think I've heard different figures on this recently, but some people I think they should keep 10% of annual revenue sort of on hand at all times to give a bit of a buffer. I think that's probably quite a good idea if you can afford to do it.
I think 10% is good. It's like everything else. I fiddle with it just to make my numbers work, but in reality, 10% probably wouldn't cover mine. But I know from an accountancy perspective, we always looked at 5% because that 5% was wear and tear. Back when we were doing that. But if I looked at it now, as an overall percentage of revenue, it's probably going to be somewhere between 5 and 10% actually, and is a good thing to project out. And I'll say to anyone, if I was starting again now, I would definitely sit down and do my 12-month forecast. And for me, I just got excited about building a property portfolio and just went off with it. But
it is an exciting proposition.
It is,
and actually a lot of the day-to-day stuff is quite exciting too. I still love going around and looking at new properties. So.
Yeah, which I have to do today actually.
Yeah, cool. So perhaps we should bring this to an end then before we make you late for your property viewing.
Yeah.
So, Stuart, why don't you tell us where the show notes are?
Show notes will be on the businessofproperty.com. We'll put a glossary of the terms that we've used and any other what we consider useful information for you on the show notes page.
They'll be very short.